All right, welcome back, focused learners. Today we're diving into another explainer, and we are putting a laser focus on a standard that has honestly caused a ton of headaches for ACCA financial reporting exam candidates. I'm talking about IFRS 15. It's one of those topics where the standard literally reads like it was written in a completely different language. Specifically, we're going to master the seriously tricky concepts of contract assets and contract liabilities. So, if you've been spinning your wheels trying to figure out exactly what the examining team actually wants from you, well, you're in the right place. Okay, let's dive into this.
Here's our roadmap for today. We're going to cover 1. The IFRS 15 impact. 2. Defining assets and liabilities. 3. The IAS 11 confusion. 4. The simple calculation method. And finally, FR exam cost rules. By the end of this, you'll have the exact exam-approved formula ready to go.
Okay, let's jump straight into Section 1, the IFRS 15 impact, and how the revenue rules completely shifted.
So, back in the day, a hard line was drawn in the sand. The application of IFRS 15, which is officially called Revenue from Contracts with Customers, became absolutely mandatory globally for any reporting periods starting on or after January 1, 2018. And listen, this wasn't just some minor tweak to the rulebook. It permanently changed the game for how businesses all over the world recognize their revenue. The entire core principle shifted to focus on the transfer of control. This meant companies had to literally tear up the old playbook and completely reevaluate when and how they book their top-line numbers.
But here's the thing. That impact, it definitely wasn't felt equally across the board. For a lot of businesses, like your standard retail shops where you hand over cash, grab a product, and go, IFRS 15 had little to zero effect. The transaction is practically instantaneous, right? But for other sectors, wow, the ground completely shifted beneath their feet. Telecom companies suddenly had to figure out contracts with multiple performance obligations. Think about when they sell you a phone handset bundled with a 2-year data plan. And construction companies, they took a massive hit because they deal with super complex contracts that span across multiple periods. The amount and timing of their revenue recognition fundamentally changed, and that required a whole new level of precision to track progress over time.
Moving right along to Section 2, defining assets and liabilities. Let's break down some of this heavy jargon. First up, let's look at the formal definition. IFRS 15 defines a contract asset as an entity's right to consideration in exchange for goods or services transferred to a customer. But pay super close attention to this last part. It's when that right is conditioned on something other than the passage of time. Now, what does that actually mean in plain English? Basically, it means it's conditioned on your future performance. You can't just sit back, kick your feet up, and wait for the clock to tick down to get paid. Nope, you actually have to do more work, maybe hit a specific project milestone to earn the unconditional right to that cash.
On the flip side, we've got the contract liability. The standard defines this as an entity's obligation to transfer goods or services to a customer when you've already received consideration, or if the amount is already due because, say, you've sent them an invoice. To put it simply, it's a formal obligation because the money is already sitting in your pocket, or it's contractually on its way, but you haven't actually done the work yet. You owe the client performance. It's all on you. All right, let's pull this out of the textbook and translate this dense terminology into a real-world scenario. A contract asset simply means you did the work, you've legitimately recognized the revenue because you transferred control, but you haven't issued the invoice or been paid yet. You're just waiting to cross that next milestone so you can finally bill them. A contract liability is the exact opposite. You've invoiced the customer, or maybe they prepaid you, but you haven't actually lifted a finger to do the work and earn that revenue yet. So the payments you've collected basically exceed the revenue you're legally allowed to recognize so far. Now, depending on the context, you might actually see these concepts wearing different disguises. A contract asset is sometimes called accrued income, while a contract liability is often called deferred income. But, and this is a huge but, here is where examiners absolutely love to set traps for you. Whatever terminology you use, you have to remember that these items are strictly distinct from trade receivables. A trade receivable only arises when you have an unconditional right to payment. And that only happens after an invoice has been officially issued. A contract asset? That means the invoice hasn't been issued yet. Falling into the trap of mixing these two up is a classic rookie mistake. So please, make sure you keep them firmly separated in your mind.
That brings us to Section 3, the IAS 11 confusion, or, as I like to call it, how to avoid outdated standards. So the ACCA examining team noted a massive recurring problem. Actually, it's literally one of the top reasons candidates needlessly throw away marks on revenue questions year after year. They're consistently getting the calculations for contract assets and liabilities completely wrong. Why do you think that is? I mean, what trap are they all falling into?
Well, here is the culprit. They're using the old rules. You've got to think of IS 11 construction contracts as an accounting zombie. It is completely dead, superseded entirely by IFRS 15, but it just keeps haunting exam papers. Let this be a massive, flashing neon warning sign for your studies. Do not use the accounting requirements of IS 11. Seriously, if your textbook or your notes mention calculating the estimated profit or loss on the entire contract to find your asset or liability, unless you're specifically checking if a contract is onerous, you're using the old, wrong standard. Don't let a zombie standard eat your exam score.
Okay, let's get to the good stuff. Section 4, the simple calculation method, your exam-approved formula.
If you thought the old way was overly complicated, you are going to absolutely love how the new standard handles this. Because this is it. This is the entire technically correct formula under IFRS 15, provided straight from the FR examining team. It tells a really simple story of a transaction. First, you just calculate the revenue recognized to date, which is based on your stage of completion. Then subtract the amounts you've invoiced to the client to date. If your result is a positive number, boom, you have a contract asset. If the result is a negative number, which means you've invoiced for way more than you've actually earned, you have a contract liability. Think of it like this. Say you've recognized $10,000 of revenue to date because you've done a portion of the work, but you've only invoiced the client for $8,000. Well, you have a positive $2,000 contract asset. It is genuinely that straightforward. Recognize what you've earned, subtract what you've billed. Simple as that.
All right, final section, number 5, FR exam cost rules and how we handle contract costs.
So, getting the revenue side right is definitely half the battle, but you also need to know exactly how to handle the costs incurred to fulfill these contracts specifically tailored for the FR exam environment. Luckily, the examining team has provided a super helpful simplification for you. Any costs incurred to fulfill a contract should simply be expensed to the statement of profit or loss as they're incurred. The assumption here is that these costs relate directly to the current year's performance. Now, sure, in the real world, costs relating to future obligations would be recognized as a contract asset, but the examiners have explicitly stated that this specific scenario is absolutely not examined in the FR exam, so you can breathe a big sigh of relief right there. However, you do have to watch out for one exception. If you buy plant or equipment specifically for a contract, that falls straight under IAS 16. You have to capitalize that asset and depreciate it, with the depreciation charge becoming an allowable cost of the contract for the year. Makes sense, right?
I want to leave you with this direct quote straight from the FR examining team regarding that simple calculation table we just looked at. They said, the calculation of the contract asset under IFRS 15 outlined above is the technically correct one, and the FR examining team will only accept this approach. Guys, they literally could not be clearer. You are now armed with the exact knowledge and the only accepted method to conquer IFRS 15 on your exam. So I'll leave you with this question. When you sit down for your test, are you going to be one of the few who confidently locks in these marks, or are you going to let the ghost of an outdated standard drag down your score? The choice and the formula are now yours. Thanks for joining this explainer, and I'll catch you in the next one.